Hello, this is Charlene. We're going to be talking about calculating the cost of a home. But before we get to the calculation part, let's talk about a specific situation. This says for a $325,000 mortgage at 6% interest for 30 years, monthly payment will be $1,948. So I want to talk about a couple of things. One is the word mortgage. The word mortgage is just a fancy word that just means the loan that they give you for the house. So it just has a special name. A mortgage is a loan for a house. Um, and our monthly payments, we are making payment every single month of the year. So that means that we will make 12 payments every year. And those monthly payments, sometimes people just refer to it as their house payment. So the house payment, again, here says that it is $1,948.54. But 100% of that does not go to the house payment. It's like we want to think, oh, well, I'm paying $1,948 on my house. No, that is not what is happening. It is allocated into two different pots. The first pot is going to be the interest pot. The interest, which comes out of that $1,948 figure, is going to be $1,625. So the interest is not going to go to your house loan. The interest is going to go to the bank. That's how they make their money. That's how that they can lend other people money. That's how they get lots of money to lend to other people. So the second pot that your house payment is going to be allotted to is going to be the principal. The principal is the part of your house payment that is going to actually pay on your loan. It's called a principal payment, and it's going toward your principal loan or the beginning amount of your loan. Every month, that principal goes down, though. So the first month, your house loan is only going to go down $323.54. So I just wanted to kind of talk about those things first before we get into the calculation. So the word mortgage is a fancy word for the loan for the house. You do have a big monthly payment, but it is not all going to your loan. Big part of it goes to the interest, which goes to the bank. Now we're going to look at a graph, which helps kind of visually explain what is happening with our house payment. Our full house payment was the 1,948.54, and the $1,625 is about the interest. And that number right there lines up with about right here. There's our starting interest. This number down here, $323.54, that is the amount that is allotted to pay toward our actual loan. And it lines up with the beginning of the graph right there. So this top line is the interest. This is the interest line. That looks funny. Yeah, I think it's spelled right. Okay, so that's the interest line. So this entire line up here is the interest line. And if you notice, it starts high. The amount of interest at the beginning of the loan is very high. The line down here at the bottom is the amount of money that is going to pay down your loan. That's known as the principal payment. So the principal payment, which is what is actually going to pay down your house loan, it starts low. It starts low. So, and the reason for this, why is it the interest up high here? It's because the bank needs to get their money up front. They need to make as much money as they can up front. So you send them a lot of interest at the beginning of your loan. And then at a certain point, though, over here we have a certain point, and that is at the point at which um, you will be making about the same amount where it's equal. Anytime you have two lines intersecting on a graph, that means they are equal at that point. So they are equal at that point where they cross each other. And this is, according to the makers of this graph, that should be about these are months, about month 223. So that 223 months into your loan, you will be making equal amounts of payment to interest and your house loan. And then for the remainder of your loan, after that point of equilibrium, your principal payment that is paying down your loan will get higher and higher and higher, and your interest will get lower and lower and lower until eventually you pay off your loan. And then guess what? Guess how much of the house you will own at the end of that. That means you will own 100% of your house, and that will be a happy day. Now we're going to work on calculating the cost of a home. Our information on this problem says the price of the home is $406,250. It says the bank requires a 20% down payment and it requires 3 points at the time of closing. The cost of the home is financed by a 30-year fixed rate mortgage at 6%. So the first thing we're going to focus on is this down payment, 20% down payment. They want us to find the required down payment. So how are we going to do that? It says 20% down payment, and that's literally going to give us what we need in order to calculate this. 20% of the sales price of the home. 20% of the sales price of the home. Well, we never calculate with the percent. We actually take the 20 and we divide it by 100, and that gives us the decimal version of that number, and that's going to be 0.20. So 20% will be converted to its decimal version, and the word of always, always, always means multiply. So we are going to multiply that. And then the sales price of the home is the 406,250. So that would be 0.20 times 4,006 or $406,250. And when we put that into our handy dandy calculator, we are going to get a number of 81,250. So the down payment for our house is going to be $81,250. Okay? So the next thing it wants us to do is it wants us to find the cost or the amount of the mortgage, the amount of the mortgage. So we're going to do that. We're going to find the amount of the mortgage by taking the cost of the home. So we're going to take the cost of the home and we are going to subtract the down payment. So the cost of the home will be 406. Uh-oh, 406. Okay, not now. 406, $250 minus the down payment of $81,250. And when we do that calculation, that is going to give us a mortgage. The mortgage amount is going to be equal to $325,000. So that's how much we're going to borrow. Mortgage is how much we will borrow. Mortgage. How much to borrow? How much to borrow from the bank? Okay, and that is going to be the amount right there, $325,000. So much we're going to borrow, and that will be called our mortgage. The next part of our question focuses on the 3 points that are required to be paid at the closing. So we're going to kind of look at what are points? What is the point of points? and what's some information that we can learn about that? So this says when you pay points on a mortgage, you're essentially prepaying a portion of your interest up front. This results in a lower interest rate on your loan, leading to smaller monthly payments over the life of the mortgage. Each point typically lowers your interest rate by around 0.25%, and each point costs 1% of your loan amount. Some banks do not require buyers to pay points on a mortgage, and many lenders have shifted away from requiring them. In fact, buying points is optional for the borrower. However, some lenders assume that points are being purchased and include them in their advertised rates. So when you see advertisement, it says that the mortgage rates are like 5.25. That may not be absolutely true because they may give you a 5.25% interest rate if you're paying points. But after we get through with this calculation, and you see how much the points are going to cost, you may or may not want to pay those points. So if you do not want to pay those points, then your interest rate will end up being higher for 3 points. And if they advertised at 5.25%, your interest rate would probably go up to at least 6% um, if you're not willing to pay the points. But according to this information we were given, it says that cost of their points is 1% of the loan, which means that 3 points would be equal to 3% of the loan. 1 point would be 1% of the loan, 2 points would be 2% of the loan, and 3 points would be 3% of the loan. But our problem that we're talking about specifically said that it is a 3 point requirement to be paid at the closing. To answer the question, how much must be paid for the 3 points at closing, we will use this calculation because 3 points are calculated by finding 3% of the loan amount. And of course, the loan amount is the mortgage amount. That's the amount that we are borrowing from the bank. So we're going to use the decimal version of 3%. The decimal version of 3% is 0.03. And we will multiply that because the word of always means multiply. The loan amount we determined earlier was $325,000. So when we calculate that, we are going to find that our cost of our 3 points will be $9,750. Now, if you have the $9,750 to bring to the closing, it's a great deal in terms of how much interest that you will save in the long run of your loan. But if you do not have the money to pay for the 3 points at closing, then you will get a slightly higher interest rate, but you will not have to pay the $9,750 at closing. Now we're going to determine the monthly payment. That's not including any taxes or insurance. So we're not concerned about that in this video, just the monthly payment here. So going back to our original information, it said that a price of a home is $406,250. It said that the bank requires the 20% down payment and the 3 points. And then it also tells us that the cost of the home is financed by a 30-year fixed rate mortgage at 6%. So we're going to use some of those pieces of information in our equation. Here is our nice big equation to find the payment amount for our mortgage, for our house loan. So we've got this number right here that says P, or this letter, this variable in our formula, and it says P. Well, the P stands for principal, but that is also the same thing as our mortgage loan amount. And earlier we calculated that our mortgage loan amount was equal to the $325,000. So this P is not the cost of our house. This P, the principal loan, is the mortgage amount. So don't make that mistake of thinking that the overall cost or price of the house is what goes in this formula. It is not. It's only the amount that you are going to borrow. We were borrowing from the bank 325,000, and that is our principal loan amount. So that number will go in that position. Okay. We also have some information from our problem that says that we have in fact, I'm going to change the color. Let's see here. Um, okay. It says that we have a 30-year fixed mortgage rate. Well, 30 years is the time, and that means that 30 is going to go where this T is in our equation. And then we have a 6% rate. So that not 6, but what is it going to be? It's going to be 0.06, 0.06. That number is going to go into the rate position. So that number will go into this position where the R is, and also where this R is as well. And then how many times a year do you make a house payment? You make a house payment 12 times a year. So the N is going to be equal to 12. And of course, the N is here, here, and here. Something I want to point out um, that kind of maybe helps you keep it straight which equation you need to use for the payment on a house is that as you pay on your house, the balance that you owe is going to go down. So that negative right there on that in that exponent position, that's a negative. It means something's going down. Something's going down. So the balance on your loan is going to go down. So always make sure that you're using the correct formula to find the payment of a house, which is going to make your balance go down. And when we think of going down, we think of going in a negative direction. Okay. So now we're going to go ahead and put all those numbers into our equation. So we're going to do the principal amount, which is going to be 325,000, and that is going to be multiplied times the ratio of the rate over the number of payments per year. So the interest rate is 0.06, and we're going to make that payment 12 times a year. Then we're going to go down to our denominator, and we got lots of brackets or braces. When I put it in the graphing calculator, I tend to just use parentheses, but if you can find the bracket on there, that's perfectly well too. So anyway, bracket 1, parentheses, 1 plus, again, we're going to use the same ratio, 0.06 interest rate, 0.06 interest rate divided by the number of payments we will make every year, which is 12 payments per year. Close that parentheses, and then I'm going to go up to the exponent, and it's going to be a negative. The number of payments we will make a year is 12, and I'm going to multiply that times the 30 years that I'm going to be making payments on my house. So when I put that in my calculator, it gives me a payment of $1,940, and we're going to round this up. It says the 9 is big enough to change that 3, so I'm gonna round my payment up to $1,948.54. The next part of our question wants us to find the total cost of interest over the 30 years. Well, in order to find the total cost of interest, we first must find what all of my house payments add up to. So my house payment was $1,948.54. And I'm going to make that payment 12 times a year. So like 12 times a year. And I am going to make that payment 12 times a year for 30 years. So I'm going to multiply all those numbers together, and that will tell what the total of all of my house payments are over the course of 30 years. When I do that calculation, I get that all of my house payments are equal to 70,000, oh, 701,474 dollars and 40 cents. So that is a lot of money. So my house only cost me over 400,000 originally, but in interest and house payments, I have made a total of $701,474.40 in house payments. So I'm going to take that number, all my house payments, which is going to be $701,474.40, and I'm going to subtract my loan amount. Well, remember, my loan amount is my mortgage amount, which is the same thing as my principal amount. And that amount was $325,000. And when I subtract those two, my interest will be the difference between those. All my payments minus how much I borrowed will give me the interest total. So when I do the calculation, it gives me an interest total. My interest total is going to be $376,474.40. So that is the total amount of interest that I will pay the bank. That is how the bank makes their money. The last part of our question wants us to find the total cost of the home. The total cost of the home. Well, we find the total cost of the home by taking all of my payments, all the totals of my payments, and I'm going to add the down payment. The down payment is what I paid up front at the bank when I first bought my house. So if you remember, all of my payments added up to $701,474.40. And going back even further in this video, my down payment originally was $81,250. So I'm going to add those two together. And when I do, they are going to give me the total cost of the home. We're looking for the total cost of the home. So when I add those up, the total cost of my home is going to be $782,724.40. So I paid originally 30 years ago, I paid 81,250, and over 30 years, I paid 701,474.40, and it gave me a grand total my house cost me of $782,724.40. So I hope that helps you understand how to go through this process of calculating the cost of a home. And I hope you will click on the like button and the subscribe button and come back another day.